So this video's main focus is on divisional performance management, and we want to get familiar with such formulas such as the return on investment, the residual income, and just get to understand what all those terminologies mean and how best we can well acquaint ourselves with that. So we'll begin by that question that you're seeing on the screen, which says the biscuit division, that's division B, and the cakes division, that's division C, are two divisions in a large manufacturing company. Whilst both divisions operate in almost identical markets, each division operates separately as an investment center. Each month, operating statements must be prepared by each division, and these are used as a basis for performance measurement for the divisions. Last month, senior management decided to recharge head office costs to the divisions. Consequently, each division is now going to be required to deduct a share of head office costs in its operating statement before arriving at net profit, which is then used to calculate return on investment, that's ROI. Prior to this, the return on investment has been calculated using controllable profit only. The company's target return on investment, however, remains unchanged at 20% per annum. For each of these 3 months, divisions B and C have maintained return on investments of 22% per annum and 23% per annum respectively, resulting in healthy bonuses being awarded to staff. The company has a cost of capital at 10%, and the budgeted operating statement for the month of July is shown below. So we can see for the two divisions, that's their operating statements and their net profits, and of course what we would call their divisional net assets. Okay, so let us calculate what we're being told here. Calculate the expected annualized return on investment using the new method, that's part 1. Okay, the new method prepared by the senior management based on the budgeted operating statements for each of the divisions. So based on the new statements, so the new statements, okay, these are the ones we are just seeing here, the ones which they've shown us, the operating statements, that's for B and C. And how do you calculate return on investment? Okay, the formula is the divisional profit or the net profit that you realize from the same period. Then you're going to divide that by the division on net assets. That's basically your formula for return on investment. So we're going to do that for both divisions, and we'll calculate as we have been asked. That's all. That's what we're going to do for part 1. Just calculation, and that's it. No need of explaining. They would have told us, but here it's just calculate. Yeah, so we'll do that for B and C. And they said what? Take note of that keyword which is underlined in red. Annualized. So we need this particular figure. We need to take note of this word annualized, because this is just a month. Trust me, this is just a month. If you look at it, this is a month of July. It's not the entire, so therefore we'll have to make it annual. So let's do that. Well, so now we are calculating return on investment for A and B. Let's start with A. Also, let's start with B. It's B and C. Yeah, so division of profits, that's your formula first. You write it so that you can know it first as well. Division profit, division no assets. So for B, take note that the profit was 311, but that's just a monthly profit because it's just for the month of July, hence we're calling it a monthly profit. Now they said annualized. So if you want to annualize something, how many months are there in a year? There are 12. So you just multiply that by 12 divided by the divisional net. I was supposed to input net here in the formula. Net assets. Well, assets there. So it's supposed to divide that, giving you 23,200,000. When you divide this, we're getting 16.09%. You can be multiplied by 100 so that at least you can view it in form of percentage. It's much easier to interpret from there. Yeah, that's basically for B. You will also do the same thing for this other department, that's division C there, which is also going to have its return on investment as its profit was 292 times 12 to annualize it, and of course times 100 everything. What's the net assets here? 22,600,000. You divide, you get our answers here. We are going to drop in with an answer of, oh, by the way, these profits equally, we've just been debasing. I've just been removing the last zeros, by the way. But on the, take note that on the asset I've been putting the entire, if it's million, I'm just putting everything there. Yeah, then when I divide, this is giving me 15.50%. That's basically the return on investment for this division C. Yeah, so that's how you calculate part A basically. Yeah. So like I was earlier trying to mention, this profit I put, the 292, it was actually supposed to be 292,000. I just did not put the last 3 zeros, but the assets I remember putting them. So maybe just for the sake of, to avoid confusion, okay, just put the entire figure the way it was. The 299 times 12 over the entire as well, this same net assets figure, everything. Just, okay, don't debase, in short. Same story with the one we solved in part B, the one which was just giving us a 311. It's also 311,000 times 12, but the answers are the same. I was just removing them, but initially on my calculator I was putting everything. So just the sake of space here on the screen. Yeah, so basically that's what I was doing on A. Let's go to B now. B is asking us that the divisional managing directors are unhappy about the results produced by the calculations in A and have heard that a performance measure called residual income may provide more information. Calculate the annualized residual income for each division, for each of the divisions, based on the net profit figures for the month of July. Equally, it's annualized. Just take note of these words. They're very important. You might just end up solving for the month of July, but you'll be wrong because you're not taking into consideration the information that they're telling you, annualized. So you have the same profit. What do they mean by residual income? Maybe that will be the next question. So let me now answer that. So when you're looking at residual income, RI, it's basically your divisional profit, okay? Divisional profit less any notional interests. That's how you know that this is residual income. When you look at the divisional profit less any notional interests on, mostly on investments, on the stuff that we're investing in, e.g. cost of capital. Because you will be told in a question that okay, you have assets of worth so much with a cost of capital of maybe 20, or let's say 15%, 11, 10%, such kind of rates. So this is the rate they're talking about, that interest rate that you're paying, the cost on that investment. That's the notional interest rates you're coming to subtract here. That's basically how I understand this. So that's how you solve residual income. So we're going to do the same thing in our question. We just want to now solve residual income now for B and C. So take note that we had divisional profits. Okay, let's start with B, which had 311,000, but you need to multiply this by 12. It's annualized. We want to respect the rules there and follow what they're asking us for. Once you annualize that profit, then now you can less the cost of capital. I hope we're together there. Why are we saying the cost of capital? That's like the interest rate they're paying on investment. As I said, it qualifies as notional interest. Just understand it like that. So you remember what was the investment? Because this cost of capital is always charged on the investment, which is the assets that you have. That's how we should understand that one. Was the cost on the capital being your assets. That's your basically your company's capital there. So the assets figure is this 23,200,000. Then you should charge 10% as your cost of capital, and you're going to get this. Okay, well, you would remove this last zero here, and then you remain with that. So 232. Yeah, so this one will just give you 23 in short. It's be like this. Okay, so basically that's what you're looking at as your interest that you're paying, which we're calling the cost of capital in this case. So basically that's what you're going to be subtracting from your net profits in this year. Then once you subtract, it will give you residual income for this particular division, which is division B, and I'm going to do that. So I've just shared a screen of the calculations, the calculator here. So we had 311,000 times 12 annualized, the profits, that's the annualized profits. Subtract notional interest from the cost of capital, which we found as 10% of the assets, that's 2,320,000. I'm landing with a residual income of 1,412,000. That's your residual income. You found it. Basically, that's how you get it. Yeah, and we're going to do the same thing for this other division, which is division C. So take note that division C's profit was how much? 292,000 times 12, 3504. What was the assets figure? It was 22,600,000, which if we take 10% of, should leave us with 2,260,000. Yeah, like this. Therefore, we end up with that as residual income, 1,244,000. That's basically how you find the residual income also for C when you're done there also. So here at this point, we're now on part C. Discuss the expected performance of each of the two divisions using the return on investment and the residual income, and making any additional calculations deemed necessary. Concludes as to whether, in your opinion, the two divisions have performed well. So here they're going to ask us to analyze what we have calculated to see if we're getting to understand what these calculations are about. So here basically what we're doing now is that we're comparing these answers that we got initially, and we're trying to see if the performance they've done well and the like. So look at division B. Let's just say this company has got a target return on investment of 20%. But look at both divisions. What particular return on investment were they both getting? B had 16.09, C had 15.50. That shows us that both departments have not done well. Why? They have not gone above target. They are working below target. That's already a sign that performance is not good. Yeah. So they even said make any additional calculations if necessary, which will be deemed necessary. So we'll also do the same thing, because understanding this information here is that we have calculated these returns on investment based on, yes, the divisional profit over the divisional assets. But remember, this profit came as a result of what? We even list certain costs that we would say are supposedly uncontrollable, because they told us initially that when we list controllable costs, we understand profits. Then when we further list other costs, which we are calling now uncontrollable, I'll show you when we get back the other screen, and these are the ones we're calling uncontrollable costs, and that's why maybe we are getting such a return on investment. How about if we reverse ensure? That's what we're trying to do. So look at that figure, which is less apportionment of head office costs, that figure there. So this one, it just came below the controllable profit, if you notice there. So this is the figure I'm calling the uncontrollable costs, because it just came as a result of after you've determined your controllable profits. Now there were other costs that were probably beyond your management control, and that has resulted in a net profit that became lower, and probably that is why our return on investment is somewhat lower than the target, because remember, profit is very key in the ROI calculation. So therefore, us want to try another way where we add back this uncontrollable cost of the same apportionment to head office and see will things change having removed this other part of costs. That's basically what you're just trying to do, because remember, ROI just works the profit, and you have to find that profit, yes, first of all, then you can get to compare. So we go ahead and calculate the return on investment minus that other cost, which we're calling uncontrollable. Therefore, it will just be like 311 plus that 155. We add it back. Initially, it was being subtracted. Then we annualize it times 12 over the same assets, 23,200,000. Yeah, so this one, by the way, that's the profit of 311,000. This is also 155,000 as well. When we divide and multiply the answer by 100, this will give us 24.1% for division B. You've seen how things have changed. Already we can comment that minus, or when we exclude those uncontrollable costs, we're getting a high return on investment, which is even above target. So this is basically how you reason, because remember, this is performance management. You're trying to see what could have resulted. Okay, they had these costs and the like, which are controllable, yes, which they are able to manage. But where you can be able to make certain decisions, like, okay, it's this other cost that came as a result of uncontrollable nature, you'll be like, okay, this can be tilted. Maybe if we removed it, what would happen? Because we know that one is just, it came as a result of, it was just uncontrollable costs. They couldn't do anything about it. So now that's why maybe the return on investment changed. But we'll leave everything else untouched, because those are controllable costs. You should be able to control as a business, and that's why you got such a profit. Unless this one, that is why we've only picked on the uncontrollable part. So you've seen here that it has increased for B. Let's look at C as well. So this time around we had 292,000. Add back what they had as uncontrollable there, 180,000, times 12, annualize that figure. Over the assets figure was 22,600,000. We are finding 25. So we are finding 25.06, and that's the answer we're getting there. Yeah, so basically that's what's going on. Then we can compare. C, it has also increased. It was initially 15.5, now it's 25.06. That's an increase. That's already something positive. So we can just comment and say that with the initial calculation where we had that uncontrollable cost, we had a lower return on investment, which was even lower than the targets, and they did not do well in that case. But we said, suppose that we did not have this uncontrollable costs, they are actually performing well, and these are the answers they would need from you, because they're just trying to see how you can reason on the matter. Yes, and that's it for part C. And so when you also look at residual income, we know that it's the same division of profits minus any notional interest that you're getting. Yeah, basically I'm just repeating the division of profit, but remember, we're removing the uncontrollable one. That's what we're doing. Then we just come and subtract the notional interest, which is the same cost of capital, 232. You'll find that here we're just getting a higher as well residual income than we got before. So you can just be able to even tell that even the other one will equally increase, because you're taking back what was initially reducing profits. That's basically the logic that we should see from this. Yeah, and that's why we can say even residual income will be better off minus that uncontrollable cost. That's how you answer part C. We are now answering D. Division B has now been offered an immediate opportunity to invest in new machinery at a cost of 2,120,000. The machinery is expected to have a useful economic life for 4 years, after which it could be sold for 200,000. Division B's policy is to depreciate all of its machinery on a straight line basis over the life of the assets. The machinery would be expected to expand Division B's production capacity, resulting in 8.5 increase in contribution per month. Recalculate Division B's expected annualized return on investment and annualized return on residual income based on July's budgeted operating statement after adjusting for the investment. State whether the managing director will be making a decision that is in the best interest of the company as a whole if return on investment is used on the basis of this decision. So we want to calculate what? The two measures again, but in a scenario where there's a possible machinery that they can invest in with that cost. So let's use the information and calculate this as well. So let us calculate the residual return on investment first. So remember, this time around, we're not going to start removing any uncontrollable costs. We're just going to take the statements as they are, as of the operating statements given. That's what the question even was mentioning there. So remember, we had divisional profits there of 311,000. If we annualize that, that's going to give us 12. Okay. Then take note that we will need to also add on a contribution. They said that it will increase contribution by 8.5%. So that's an additional benefit to the profit. So it will increase. It's like an income. Incomes increase profits. Should also take note of that. So let's do this. There's this 600,000. That was the contribution initially. Now times 8.5. So that we can know what increase. This is going to give us 8.5%. Once we do that, we'll have the overall profits there. That will be total profit on top. Then from there, it will just be a matter of coming to divide with the assets. The assets have equally changed. We had initially 23,200,000, but if we purchase this one, the assets figure will be this now, the the machinery, and the format total. That is what we're going to have as our return on investment figure now. So we just haven't included one more thing before we calculate our return on investment. Remember, there's a new machinery, and they've talked about depreciation. So remember, depreciation from your accounting, your normal financial accounting, depreciation is supposed to be subtracted so that you can arrive at your overall net profit. Yeah, so what you're going to do is that calculate DIP for, first of all, the assets depreciation. They just said it's for 4 years. And let's say this is cost to 2,120,000. Then they said that it could be sold at the end of its useful life. This is what we call salvage, by the way. That price that you can sell an asset for at the end of its useful life, that's salvage value over number of years being 4. Okay, this is 4 years. Yes. So the only thing is that this is the July profit. So now if we're going, this answer, it will give us depreciation as pay. Now as we want, what depreciation could they have recorded in the month of July? Therefore we want to find the monthly dip. So what is 4 years in months? That's 48 months. That's why we're doing this is because we want to find the monthly dip for in July, because this is the statement for July, if you get the logic. That's why I'm going to that extent of finding the monthly dip, which is going to give me 40,000. And once I know the monthly dip, I'll just be subtracting from the above calculation on top. So I'll just go on the top there and say minus 40,000. Just remember you record that as well, minus 40,000. Then once you do all that, you do the calculation there on top. And by the way, this annualized profit, I also need to put it in advance. So in short, let's just write it like this. You've seen what I've done on the top. Remember, it's a profit. We're supposed to find the divisional profit. So I started with my 311 as the net profit that was shown. Then I added the contribution that will be increased by this investment. Then I subtracted depreciation, because depreciation is not an addition to any profit, it's just a reduction in your profit. So you have to also remove it and subtract, and that's what you do on the top. Then remember, you're dividing by the divisional net assets. The net assets, as I said, they have now increased from the figure you had as 23,200,000 plus the 2,120,000. Therefore, we will end up with a return on investment of 15.26%. Of course, once you multiply our answer by 100, it will give you 15.26%. And basically, this is how you would calculate return on investment, given that you have another additional investment that is coming up, like machinery. So when you go further now to residual income, remember, your profit is now this numerator. Profit has changed because you've now brought in DIP and the like, and this is your numerator. This is now the profit you'll be looking at. That's the one you're now going to less with notional interest. So what is the notional interest? Good, that question. If you reason on that, what would be the notional interest here? So I've just brought you to this calculator so you can see how the calculation will be moving. So let's say we had that 311 plus when you say 8.5% of that contribution, it gave me 51. Okay, give me 51, that's 362, minus depreciation, I got 322, annualize that figure times 12, I'm getting that. Then now that's basically the profit you'll be working with now, 3864, because you've taken into consideration DIP, you've taken DIP out, you've added the contribution that it will bring to you, and 3864 is your profit at this point. Then remember, it's just subtracting by notional interest. That's how you get residual income. Take note that your assets were initially this was initially 23,200,000 plus 2,120,000 there. Then when you add these two, it gives you the new asset figure. Then notional is just 10%, 2532, 2532, which is subtracted from 3864. So 3864 less 2532, 3864 less 2532, we are getting 1332 as our residual income with this investment. You would comment, should they go ahead with the investment? The answer is no. Why do we say that? As you can see, residual income is now 1332. Initially, without the investment, they were getting a residual income of 1412. That was for division B, if you recall. That was division B's particular division B's particular residual income before the investment. It was 1412. Now it's 1332. That's a reduction. You can't go ahead. Then if you look at ROI, it was initially 16.09, if you recall. Now that they have invested, it's 15.26. That's a decrease. You wouldn't want to invest, because that would not be in the best interest of the company, and that's the answer you give there. So they just said for division B, and we're only solving for B. So if they even asked for C, just remember this is the approach you're taking. Just remember you have an investment, you take in consideration DIP, any other things, that other benefits to bring, and you put them in your calculation. Basically, this is how you had to approach these few questions there up to D.